Welcome to the Opening Bell Report.
Welcome in. If you track the biotech sector, you likely saw the headlines lighting up the boards recently.
Oh, yeah. Hard to miss.
Right. IOVA stock surges 12%. And, it begs the question, is this the start of a massive run?
It's the question everyone is asking right now.
Yeah. Now, we both know that for a small or mid-cap biotech firm, a 12% move in a single trading session isn't exactly a black swan event.
No, not at all.
I mean, in this sector, 12% can sometimes just be a volatile Tuesday.
Exactly. It's biotech.
Right. It's biotech. But what makes Iovance Biotherapeutics, ticker symbol IOVA, so compelling right now isn't just the percentage point itself. It's the underlying context.
The context is everything here.
It really is. So we've got our hands on a comprehensive financial analysis report detailing their current operational metrics. And our mission for this deep dive today is to unpack this data.
Right.
We want to figure out for you if this is just a fleeting momentum trade or a fundamental repricing of the company's core valuation.
Because there's a huge difference.
A massive difference. Okay, let's unpack this, because looking at the chart, that 12% move didn't just happen in a vacuum. It pushed the stock right against a critical technical threshold.
It did. And that is where the distinction between just retail noise and actual structural market shifts becomes apparent.
Right.
The surge pushed Iovance right up against its 52-week high.
Which is a big deal.
Huge deal. When you see a stock approach a 52-week high with that kind of velocity and, sustained volume, you are looking at the footprint of institutional capital.
The big money.
Exactly, the big money. Asset managers, hedge funds, mutual funds, they are repositioning. They aren't just throwing capital at a chart because it's green today.
Right, they have months.
They're allocating based on a very specific set of operational executions that Iovance has just demonstrated. I mean, institutional models demand hard data. And the data in this analysis report suggests a major de-risking event has just occurred for them.
Right. And that de-risking event, it points directly to the catalyst detailed in the analysis report. I'm talking about their Q4 2025 earnings.
Yes. The earnings report was the trigger.
But let's look at these numbers critically for a second.
Okay.
The report highlights that Q4 product revenue came in at approximately $87 million.
Right.
Now, Iovance is a multi-billion-dollar company. In the grand scheme of commercial pharmaceuticals, $87 million in a quarter is, it's a rounding error for the mega-cap players.
Sure, for a Pfizer or a Merck, absolutely.
Right, so why is institutional money salivating over an $87 million quarter?
Because in early-stage commercial biotech, the absolute number is secondary to the velocity of the curve.
The velocity.
Yes, it is all about the trajectory. That $87 million, it represents a 30% quarter-over-quarter growth rate.
Wow.
And that's not year-over-year. That is sequential quarter-over-quarter growth.
Just from the previous 3 months.
Exactly.
Yeah.
Achieving a 30% jump in a 3-month window is incredibly difficult to execute, especially with a complex biological product.
Right, it's not just pills in a bottle.
Not at all. And when you extrapolate that momentum, their full year 2025 revenue hit $264 million.
Which means they hit their targets.
Safely. They landed safely inside their own highly ambitious forward guidance.
Which is an anomaly in itself. I mean, the graveyard of biotech is filled with companies that get FDA approval, they promise the moon on their initial rollout, and then completely miss their first 4 quarters of guidance.
Oh, it happens all the time.
Because the real-world commercialization is infinitely harder than the clinical trials.
Exactly. And what's fascinating here is what hitting those numbers represents strategically in the broader market.
What do you mean?
It fundamentally shatters the core thesis of the short sellers.
Ah, right, the bears.
Yes. There has been a heavy vocal contingent betting against Iovance for years.
And their bear case wasn't necessarily that the science was slow.
No, the science is proven. The bear case was that Iovance would never be able to profitably scale and commercialize their flagship cellular therapy, Amtagvi.
They thought the logistics would crush them.
Exactly. The bears modeled for logistical bottlenecks, massive cash burn, and stalled revenue. But this earnings report, it's undeniable mathematical proof that the commercial rollout is actually working.
So they handed the market an $87 million receipt.
In a single quarter, proving the skeptics wrong on the very premise of their short thesis.
I want to dig into that bear thesis, though, because it wasn't entirely baseless.
No, it was a very rational fear.
Right. So to understand why institutional money was so skeptical and why this revenue beat is actually a massive triumph, we need to talk about why cellular therapy logistics are notoriously brutal.
They are a nightmare to scale.
Because we aren't talking about a small molecule pill that you just stamp out by the millions in a chemical plant.
Right.
The analysis report makes it clear this is a highly personalized autologous cellular therapy. How exactly Do the logistics of Amtagvi justify the market's initial skepticism?
It is arguably one of the most complex supply chains in modern medicine.
Walk us through it.
Imagine if, instead of ordering a mass-produced product from a warehouse, you had to send a manufacturer a fragile, broken piece of your own watch.
Okay.
They have to receive it, custom engineer that exact piece in a specialized lab to make it run exponentially faster, and then safely ship that exact living biological piece back to your specific address within a matter of days.
That sounds incredibly fragile.
It is. If the temperature fluctuates during shipping, the product dies.
Wow.
If there's a mix-up at the lab, the consequences are catastrophic. That is the reality of Amtagvi.
Because they're using the patient's actual cells.
Yes. You extract immune cells directly from a cancer patient, keep them viable, transport them to an engineering facility, multiply and enhance them, and ship them back for reinfusion into that exact same patient.
Just for that one person.
Exactly. It is a bespoke, biological, high-stakes manufacturing process for every single individual.
And that biological supply chain is where so many competitors just bleed to death.
They run out of money trying to perfect it.
But the analysis report gives us a data point that proves Iovance is not just surviving that process, but mastering it.
The margins.
Yes, the margins. It's not just the 30% sequential revenue growth, it's the margin expansion. The report notes their gross margins have rapidly improved to roughly 50%.
Which is staggering for this type of product.
Well, let me push back on that for a second. Can a highly custom autologous manufacturing process really sustain a 50% gross margin?
It seems counterintuitive.
Yeah, custom manufacturing usually scales terribly. What is driving that efficiency?
It's a great question, and it comes down to capacity utilization and the absorption of fixed costs.
Okay, break that down.
When you first build a specialized cell therapy manufacturing facility, your overhead is astronomical.
The clean rooms, all of that.
Right. You are paying for the clean rooms, the highly trained technicians, the specialized bioreactors, all before you treat a single commercial patient.
So you're in a massive hole from day one.
Exactly. But as your volume increases, as indicated by that 30% quarter-over-quarter revenue bump, those fixed costs get spread across a much larger number of patient therapies.
The per unit cost drops.
Drastically. Furthermore, your technicians get faster, your batch failure rates drop, and your logistics partners optimize their routing.
They get better at the game.
Right. That leap to a 50% gross margin tells Wall Street that Iovance's in-house manufacturing center is achieving serious economies of scale.
So they aren't just brute forcing the revenue.
No, they are demonstrating powerful operational leverage.
And they are demonstrating that leverage from a highly advantageous market position. The analysis report notes they have established a monopolistic moat in the solid tumor space, specifically for advanced melanoma.
Yes, a literal monopoly right now.
But Warren Buffett loves a good economic moat, right?
Mm-hmm.
But in biotech, moats usually expire as soon as a competitor gets a slightly better data readout.
Which happens fast.
Very fast. So how durable is this specific advantage they have?
To understand the durability, you have to look at the science of solid tumors versus liquid tumors.
Okay.
For the last decade, cellular therapies like FAR-CAR-T have been incredibly successful against liquid tumors, blood cancers like leukemia or lymphoma.
Because they're just in the bloodstream.
Exactly. In those diseases, the engineered cells can easily circulate in the bloodstream and hunt down the cancer. But solid tumors, like advanced melanoma, are vastly different.
How so?
They construct a hostile, immunosuppressive microenvironment. It is essentially a physical and chemical fortress that traditional engineered cells struggle to penetrate.
They just bounce right off?
Essentially, yes. Iovance's therapy relies on tumor-infiltrating lymphocytes, or TILs.
That's IELs, right.
They literally harvest the immune cells that have already breached the tumor's fortress, pull them out, multiply them by the billions, and send them back in.
They're using the body's own special forces that already know the way in.
Perfect analogy. Because they cracked this specific biological challenge, they currently have no direct commercial peers in this specific cellular therapy lane for solid tumors.
So the moat is deep.
Very deep. It is a highly defensible position because the barrier to entry for competitors isn't just regulatory, it is fundamentally scientific and logistical.
Okay, so they have the scientific moat and they have the margins.
Mm-hmm.
But let's look at the balance sheet.
Always the crucial part of biotech.
Always. Because building and maintaining that custom biological supply chain is capital intensive. The analysis report states Iovance is sitting on roughly $303 million in cash.
Right.
But I have to ask, is $303 million really that much runway? They are expanding their physical treatment center network nationwide and running massive clinical trials simultaneously. Doesn't that burn rate eat through $300 million incredibly fast?
In a pre-commercial biotech, yes, that cash would evaporate rapidly.
It'd be gone in a year.
Easily. But the dynamic shifts entirely once you have commercial revenue offsetting the R&D burn.
Right, the $87 million quarter.
Exactly. Management confirmed that this $303 million funds their operations deep into the third quarter of 2027.
Wow, 2027.
Yes. The reason that runway extends so far is precisely because of that revenue growth and the 50% margins we just discussed. The commercial machine is now actually helping to fund the pipeline.
And that specific date, deep into Q3 2027, is a massive psychological relief valve for institutional investors, isn't it?
Huge.
Because it essentially takes the threat of near-term dilution completely off the table.
Completely. In this sector, if a company has less than 12 months of cash, the market aggressively prices in a secondary stock offering.
They know it's coming.
Investors know their shares are about to be diluted, so they sell ahead of the inevitable capital raise.
Self-fulfilling prophecy.
It is. By securing the balance sheet through 2027, Iovance has effectively neutralized that overhang. Institutions can build their positions today knowing the company has the capital required to execute its commercial rollout without returning to the well to tap shareholders for more cash.
Which perfectly explains why the analyst community is aggressively recalibrating. The analysis report shows Wall Street scrambling to revise their models right now.
They have to. The old models are broken.
Right. If your previous model assumed Iovance was going to struggle with cellular logistics, burn through their cash, and face a dilution event by 2025,
then this earnings report destroys your thesis.
totally breaks it. Let's look at the specific price targets highlighted in the report using a baseline stock price of roughly $5. We've got Citizens upgrading to an outperform rating with a $5 target.
Right.
But based on the recent 12% surge, the stock blew right past that.
It did, which indicates how rapidly the market price is adjusting compared to the speed of these institutional research notes.
The market is moving faster than the analysts can type.
Basically, a $5 target essentially values the company based on its baseline survival and current melanoma commercialization.
The bare minimum.
Exactly. But when you look at the broader Wall Street's consensus, which aggregates the one-year average target across multiple analysts, it sits significantly higher at $9.20.
From a $5 baseline, a $9.20 consensus is an implied upside of roughly 84%.
Yes. And an 84% implied upside on a consensus average is highly unusual.
Usually they're pretty conservative.
Very conservative.
Yeah.
They're designed to be safe blends. The fact that the average is that high suggests a widespread structural repricing across multiple major financial institutions.
But then you have Barclays. They maintained their overweight rating, but slapped an $11 price target on the stock.
$11.
If you were sitting around $5, an $11 target is a 120% implied upside.
It's massive.
That is a massive spread between the conservative $5 targets and Barclays at 11. What is Barclays seeing in their models that the lower targets are discounting?
An $11 target implies a significant multiple expansion. Barclays is likely looking way beyond the current melanoma revenues and aggressively pricing in the probability of success for Iovance's future pipeline.
They're looking at the bigger picture.
Yes. They're looking at the operational leverage we discussed and assuming that if Iovance can generate these margins in a niche market, the valuation will explode when they apply that exact same logistical infrastructure to much larger indications.
Okay, here's where it gets really interesting. Because while the analysts are debating terminal values and discounted cash flows, the actual day-to-day trading mechanics of the stock might be adding literal fuel to this fire.
Oh, absolutely. The hardest structure.
Right. We are talking about market dynamics that force behavior regardless of what the fundamentals say.
Yes.
The analysis report dives into the concept of psychological resistance levels, specifically around that $5 mark.
This is where market structure amplifies fundamental data. We established earlier that Iovance carried a massive short interest.
A lot of people betting against it.
A lot of funds were positioned for the company to fail its commercial rollout. When a stock is heavily shorted, the bears have borrowed shares and sold them, needing the price to drop to turn a profit.
Right.
But when the company reports blowout numbers, the stock rises. The pain for a short position increases exponentially as the price climbs because the potential losses on a short are theoretically infinite.
And $5 is a massive psychological and technical barrier for institutional risk models.
No,
Right.
exactly. Crossing that $5 threshold triggers risk management protocols for those short funds. Their prime brokers may issue margin calls.
They want their money.
They demand they either deposit more capital or close their positions immediately. And the only way to close a short position is to go into the open market and buy the underlying stock.
So even the funds that aggressively bet against Iovance, the ones who genuinely believe the long-term thesis is still flawed, they are structurally forced to become buyers.
Yes. The analysis report refers to this forced buying as rocket fuel.
Rocket fuel. I like that.
It creates a cascading feedback loop. You have fundamental long-only funds buying because the earnings and margins are stellar.
pushing the price up.
Right.
Right.
The higher price forces short sellers to buy back shares to cover their losing positions. That forced buying pushes the price up even higher, triggering the next wave of margin calls.
It just feeds on itself.
That combination of fundamental institutional accumulation and forced short covering is the mechanical anatomy of a sudden 12% upward surge.
It's a structural bid right under the market.
Exactly.
But what I find most compelling from the analysis report is what Iovance is doing with this newfound momentum and capitalized balance sheet. They aren't just sitting in their melanoma moat resting on their laurels.
No, they're moving fast.
The report sharply contrasts Iovance's current position with the rest of the biotech landscape.
The divergence is stark. Yeah. The macro environment for biotech has been difficult. Many of Iovance's peers are stuck in regulatory purgatory, burning precious cash reserves while waiting on FDA decisions or early-stage trial readouts.
They're just treading water.
They are in a defensive posture, fighting for survival, but Iovance has crossed the commercial Rubicon.
They have real revenue.
They have a fully approved product, they are generating substantial revenue, they have secured their cash runway, and they are aggressively expanding their authorized treatment center network across the country. They are playing offense.
And they are using that offensive posture to hunt massive clinical targets. The report notes they are aggressively pushing forward with trials for highly lucrative label expansions.
This is the key to the future valuation.
They want to take the logistical machine they built for melanoma and aim it at non-small cell lung cancer, or NSCLC. Let's talk about the total addressable market difference there because it is staggering.
It is orders of magnitude larger. Advanced melanoma is a devastating disease, but the patient population is relatively concentrated.
It's a niche market, essentially.
Comparatively, yes. Non-small cell lung cancer is one of the most prevalent and deadly forms of cancer globally. It is an enormous market.
So if they can get in there,
it changes everything. The thesis here is that Iovance has already done the hardest part. They spent years and hundreds of millions of dollars building the bespoke manufacturing facilities, optimizing the 50% gross margins, and proving to the FDA that they can safely transport living cells across the country.
they own the infrastructure.
Exactly. If their upcoming trials prove that their TIL therapy is effective against NSCLC, they don't have to reinvent the wheel.
They just plug it in.
They just run those new patients through the exact same highly profitable, optimized machine they've already built.
So what does this all mean? If you step back and synthesize everything we've extracted from this financial analysis report, the narrative is incredibly clear.
Very clear.
What registers on your trading screen as just a sudden 12% surge is actually the manifestation of years of complex execution. You are looking at a company that took the logistical nightmare of personalized cellular therapy and turned it into a reliable commercial process that yields 50% gross margins.
Which no one thought they could do.
Right. They have fortified their balance sheet to fund operations deep into 2027, neutralizing the threat of dilution. And mechanically, their success has triggered a short squeeze, forcing skeptics to buy the stock and driving analyst consensus to near triple-digit implied upsides.
The real takeaway is that knowledge in this sector is most valuable when you understand the synthesis of science and capital.
Beautifully put.
This analysis report is a masterclass in operational leverage. The market initially mispriced the difficulty of cellular manufacturing, assuming Iovance would fail where so many others have. By proving they can scale this life-saving therapy reliably and profitably, Iovance hasn't just improved their balance sheet. They have fundamentally de-risked their platform.
The risk is gone.
Institutional capital is flowing in because the company has successfully transitioned from a speculative science project into a high-margin commercial enterprise with a monopolistic hold on a critical area of oncology.
It is a phenomenal pivot, and the data clearly supports the market's enthusiasm. But as we wrap up this deep dive, I want to leave you with one final, broader consideration to mull over as you track this company's progress.
Okay.
We have spent this entire discussion marveling at the customized, bespoke nature of Iovance's autologous cell therapy and how they crack the code on melanoma logistics.
Right.
But think about this based on what the report outlines. If Iovance has already cracked this notoriously difficult logistical code to build a monopolistic moat in advanced melanoma, what happens to their operational leverage and really the entire biotech sector if they successfully apply that exact same proven blueprint to their upcoming trials for a massive market like non-small cell lung cancer?
That is the billion-dollar question.
It really is. It's a horizon event worth keeping an eye on as this story unfolds. Keep watching the tape, and we'll catch you on the next one.
Don't forget to like, share, and subscribe for more.